This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. Welcome back to the Investing with the Whales podcast. I'm your host, Jonah Lupton. Super excited today about my guest. It's Chris Mayer. He is the co-founder of Woodlock House Capital, as well as the author of 100 Baggers. So that's certainly how I know Chris. I've read the book twice, or technically listened to it on Audible twice. It's a phenomenal book. So if you haven't heard of it or you haven't read it, I would definitely recommend it. Chris, welcome to the show.
Thank you, John. Thanks for having me on. I'm impressed. You read it twice.
I did, or listened to it twice.
Yeah.
It's a good book to listen to when you're on a plane or on a bus, and you can just kind of, you need, I wouldn't say entertainment, but I mean, you have some, you actually mentioned some stocks in there that we're familiar with and, how they turn into 100 baggers. So let's start with the book. Why did you write the book, and what are some of the lessons that we could take from that book, assuming that someone hasn't read it yet?
Yeah. Well, I always tell this anecdote. I found Thomas Phelps' book, 100 to 1 in the Stock Market, which was written in 1971. And in that book, I found that book by, there was a speech that Chuck Akre gave. Chuck Akre, famous investor, Akre Capital Management, gave a speech called An Investor's Odyssey. And in the course of this speech, he talks about how this Thomas Phelps book influenced him a great deal. And I'd never heard of it. I mean, he got all these books behind me. There's books across the hall here. I love investing books. I thought I had read every kind of obscure investing book there was, but I'd never heard of that one. So I got it and read it. And I really liked it. Phelps is a very good writer. He has a lot of metaphors. It's a very quotable book. And so when I was writing my newsletter at that time, I would quote from Phelps. And finally, I had a reader who said, you should update the book. And it was like, bang, light bulb went off. So that's a great idea. I should do that. So that's how it started. And I got the data going back to 1962. I had another analyst help me kind of piece that all together and to create this massive spreadsheet we had of stocks that returned 100 to 1, at least 100 to 1. And we had some basic financial data for all of them. And then the next step after that was trying to see if there were some things we could learn from that.
How many 100 baggers? I mean, over the last 50 years, how many 100 baggers have there been?
In my study, we found 365, which is an interesting number because that's how many Phelps had in his study. Now, there's more than that because mine was, first off, it's only listed the U.S. exchanges. Number one. Number two is I had a market cap cutoff. I think it was 50 million, and that's today's dollars. So, we adjusted it backwards. And the reason for that was to screen out some of the, there's little tiny mining stocks that trade for 16 cents and go to $3 or something, whatever. I didn't want to necessarily capture those. I was looking for things that a population that might give us something we could use to predict or assist us in, hunting for those kinds of stocks. There's a number of businesses that you're just by nature, you're never going to know, like a little mining company that hits a big find. That's nothing you can really necessarily predict from that, or a biotech company that is a science project and finally hits it big. There's those kinds of businesses. Right. So that's, we tried to screen those off.
Some of the names that that I'm familiar with that people would hear in the book. So Tractor Supply is one, Monster is another one. What were some of the other ones that might surprise people that have, been 100 baggers? And some of these stocks have been 200, 300, 400 baggers. But what are some of the other names that?
I know there's a lot of names on there. Like, people would probably be surprised to find that, there are a number of like utilities, oil and gas companies. I mean, one of the takeaways from the study I remember is that I had expected it to kind of be dominated by like Microsofts and Intels and the Home Depots and McDonald's, these great businesses that we all know. But there are lots of companies on that list. Like you mentioned, Tractor Supply was one. Yeah, certainly Monster. There are a lot of companies that are not as well known that just plod along and became 100 baggers. So it's not about industry affiliation necessarily. Like, Southwest Airlines is a big winner on there.
I mean, I would say, what about like Starbucks and Home Depot?
Yeah, Starbucks, Home Depot, definitely 100 baggers. Yeah.
Because if you think about it, like back when these companies came public, they were coming public at 200, 300, $400 million valuations versus the companies that come public today come public at 5, 6, 10, $20 billion valuations.
Mm-hmm.
So, I mean, it was probably easier to find these 100 baggers when you go back to the companies that came public in the 70s and 80s.
Yeah, and there's been some other qualitative differences. I mean, this is an empirical question. You could probably go back and look and see, what's the average IPO look like in the 1960s versus today. I don't know for sure, but I bet you would also find that in general, those companies in 1960s were a little more mature. They were more profitable.
Right.
Whereas today, you certainly have companies that go public that are far from being profitable, but they manage it anyway.
What are some of the commonalities between these companies? Is it revenue growth, earnings growth, return on capital? What do they all have in common that is allowed them to perform for so long?
Well, when I started the book, that was my hope, was to try to find, some sort of magic number or combination or something like that. But that wasn't the case, right? So it's like a mountain. If you think of reaching 100 bagger status as being the top of a mountain, there's a lot of paths up there. So I would say, revenue growth was certainly a common theme among many of them, not all, many, because you just think about it. I mean, the businesses at the end of that run, or when they get to 100 bagger status, they're a lot bigger than when they started. So revenue growth kind of starts the whole thing. And then a lot of other things feed off that, your profits and reinvestment opportunities and so on. But, there are also examples of businesses that didn't really grow so fast, but because they were consistently devourers of their own shares.
Right.
That was another way to get there. There are companies where there were a lot of spin-offs. When you you factor in the spin-offs, the overall investment easily cleared 100 baggerdom. So there's a lot of different ways, but I'd say, again, thinking about it in terms of I don't know if predictable is the right word, because you're not like you can say today this is going to be 100 bagger, but you're looking for some common elements, and one of them would be high revenue growth for sure, and then high returns on capital. Those are the two that I kind of emphasize. If you find businesses that grow, well, I like to say too that it comes down to a math problem, right? So if you grow 25% a year, after 20 years, that's 100 bagger, and so you're looking for companies that can have those kinds of returns on capital, 20 to 25. In fact, when you look at the population, it was kind of a bell curve, and most of them kind of settled in that 20 to 25 year range.
So I think it's funny whenever I see someone on FinTwit talking about, they're trying to find a 100 bagger, but you look at their portfolio and it's all 20, 50, $100 billion companies. And I don't know if they've actually done the math and realized that those companies are not doing 100x from $50 billion. So where do you find the 100 baggers? Where do they start? I assume most of them start as small caps or even micro caps.
Yeah, I mean, in the book, I think I say that they're around 300 million was the median sales. So they're actually pretty decent sized businesses. And yeah, in my fund, I own several companies that are 30 and $40 billion market cap. But the way I think about it too is, you may not necessarily be able to fill out a whole portfolio of potential 100 baggers at that small cap level. So you just sort of gradually build your way into those names as you go along. In fact, one of the things I often say is if I wrote the book again, I wouldn't necessarily emphasize that market cap so much, because I think it can be a little distracting. I mean, if you find a company that's $1 billion or $2 billion or even 10 billion market cap, and it's got all the characteristics you want, it's got really high returns on capital, they're reinvesting, it's got everything you want, checks all the boxes, are you really going to pass on it because it's $10 billion market cap? That could be a huge mistake, right? I mean,
right.
So I would say the focus more on those, the engine, so to speak, not so much on the market cap. Now, as you mentioned, you can be on the extreme end. You buy something that's $1 trillion market cap today. Okay. And then maybe that's too high. But
I mean, you just think back 10 years ago when companies like Lululemon, Chipotle were probably $2-3 billion companies, and now 50, $60 billion companies.
Yeah. I mean, I think even Microsoft, if you look at, I think it was the last 15 years, something, it's been a 10 bagger over, and that wasn't any kind of hidden secret. And that's a 10X, which I think a lot of people would be pretty happy with.
What would you say that these companies are typically buying back their own stock? Do they pay dividends?
No, I would say it's not typical that they do buybacks. I would say, and on the dividend question, and Phelps had this line in his book where he talks about dividends are an expensive luxury. You think about it, it's not, I'm not saying that a company that pays dividends is a bad investment, but if you really want to narrow it down to the highest performing stocks, those companies tend not to pay dividends for a long, long time because they're taking all their capital to grow and to,
and so market share. Yep.
Yeah. I mean, you think about it, you have a pool of capital and you get a profit. And if you pay out half every year, you have that much less to compound with in the next year. So ideally you want, maximum, you want them to use capital to grow. Now there are companies their returns on capital are so high and they don't have a need to reinvest. They throw off a lot of cash and they can grow without consuming capital. And those are wonderful, magical businesses, but they're very rare.
I mean, Apple has so much cash, doesn't know what to do with it.
I'm also thinking of like royalty companies where, you're getting a royalty off something, somebody else is doing all the work and funding all the investment, and you've just got a growing stream of cash.
Right.
You may not necessarily have, want to necessarily have opportunities to reinvest it as well. So
what is your strategy at Woodlock? And I mean, I know you don't have to get into the specific holdings if you don't want to. I assume you guys are probably set up as an RIA, and I don't think you're taking new client money right now. But is the 100 bagger? I mean, is that kind of your approach? I mean, I know you're not investing in all these small companies looking for 100 baggers, but I mean, are you looking for those types of companies and then complementing that with some more mature?
Definitely. Absolutely. Yes. So I would say, the Woodlock House is just set up as a limited partnership. It's a pooled investment vehicle. It's closed to new investors now. And strategy, I mean, I talk a lot about this on my blog and people want to know, but it's focused on the buying companies like I talk about in that book. So I'm looking for companies that have high returns on capital, have the ability to reinvest it. I like and emphasize skin in the game. So the companies I own, insiders own a good bit of the stock, or there's a family involved. So I like to have some insider ownership there. I also stay away from any kind of financial leverage. So companies I own have very little debt or no debt. Those are kind of the four key points. Are
there sectors that you really like?
I'm sector agnostic, really. I generally don't look at things that are in extractive industries like mining. I generally don't look at things like pharmaceuticals. I like industrials, like software. I've been pretty public about my holdings in Twitter and stuff. People know I own, Copart, involved in salvage. I have Old Dominion Freight, logistics. And I have some smaller caps.
That's been a huge winner. All right. I mean, that might even be 100 bagger over the last 20 years.
Oh, yeah. Yeah. And then I have some smaller caps in Sweden and one in Poland. So it's a global hunt, wherever the opportunities are, I'll go.
And when you get into a stock, how long do you think you're typically going to hold it?
All right. I go in thinking that I'm going to hold it for 10 years at least. Okay. So there should be very little turnover. Last year, I think I bought one stock and sold one, and that was it. So this year,
you still work every day. You're spending the rest of the time hunting for new ideas.
I guess if you could call this work, maybe so. But yeah, and this year I haven't bought or sold anything. Well, I got one company as a spinoff, and I've added to it. So, but other than that, hasn't been much.
What would get you to sell a stock?
Great question. I think that's probably the hardest part about investing. When do you sell? Sometimes I think it can be clear. Well, I don't know about clear, but I have, any investor should, you have a thesis why you own a stock, and I write that down. I'd recommend you write it down so you can't lie to yourself later about why you own a stock.
Right. And
if that thesis breaks, that's the time to sell. Now, what does that mean, right? Because it's easy to say that, but then in real life, it's not so clear all the time when a thesis breaks. So if a company has a bad quarter, you're going to pull the ripcord on it right away. If it has two bad quarters in a row, you're going to dump it. I mean, so it's hard to know sometimes what's just kind of a temporary setback or challenge and what's a real impairment on the long-term compounding of the business. So for me, it would be focusing on what is the business really impaired in some way. And sometimes I was thinking when I first said it would be clear, like if there was something that a company did that was clearly unethical, or there's something that they did that was definitely not shareholder friendly that I didn't like, that would be a big red flag. But otherwise, it involves a lot of judgment. It's not necessarily easy, but I try to, if a company's competitive position is compromised in some way, that might be a good reason to let it go. I emphasize that return on capital. If I am getting declining returns on capital and there's no reason to think that it will reverse, that's probably time to go. So it can be hard. I think it is hard. I think selling is very difficult.
Why haven't you bought any stocks this year? Valuation is not attractive?
I think I'm happy with what I own. I have had inflow, so I have bought more of what I own, but I haven't bought anything new.
Gotcha. Okay.
Yeah.
What would get you to change your mind? And any stocks at the top of your watch list?
Yeah, I have some stocks that I have done quite a bit of work on that I follow, that I like, and that I would own if there was some reason for me to. I have to create a spot. So I in my portfolio, I tell people 10 to 12 names. So that's very valuable real estate. I could probably take on one more because I have 11, one more, and then I'm done. So it's very careful about that, unless something else has to go out. And the way I manage it is for me to get rid of something, that the name that I add has to be clearly better, not like a little bit better or just better. It has to be way better for me to make that move, because there's taxes when I sell. There's risks that I don't know the new name as well as I know the name that I own. I could be wrong. There's a lot of things that go on. So I try to keep the hurdle very high for me to make any transactions or make any moves. And as long as the companies I own are performing well, then there's no reason to do anything.
Now,
hold on to them.
Because of your approach and your strategy, I'm pretty sure I know the answer to the next question, but you strike me as the kind of guy that doesn't really care about the CPI reports, what the FOMC is doing every month, because it really doesn't impact your companies over the long term, right?
Right. Yeah, I don't particularly care about that at all. I don't sit around wondering if we're going to be in a recession or not. It doesn't change what I will do. It doesn't change what I own. I don't worry about, what the latest CPI is or what the employment number is. I don't focus on those things. I spend a lot of time trying to understand the businesses that I own. And that involves not only, reading the public filings, but also trying to talk to people who work there, know management, looking at competitors. So it's kind of like a 360 view, really trying to understand that business, because if you're going to be a long-term investor, the market's going to test you at some point. Oops, sorry. Let me box that out. Almost any stock, this is a fascinating exercise. You take a list of stocks and you look at the high and the low for any given year. It's always a wide margin. I've sat in stocks and been cut in half, and then they triple, and then so you get tested.
So that's the other funny thing about people that claim to be looking for 100 baggers or even 10 baggers is they typically don't have the patience or the emotional fortitude to hold through those pullbacks. You look at the charts of NVIDIA and AMD and Enphase, and these stocks are up massive over the last 10, 15 years, but there's been multiple times where they've dropped 50, 60% in a year, and probably shook a lot of people out that claim that they were never going to sell it.
Right.
So how do you, you've been doing this a while, so I'm assuming you've overcome that barrier, but someone that's on the younger side looking to find a 10 bagger, what can you tell them? How do you?
Well, I'd say two things about that. One is, it's not only the fortitude to hold on when you get drawdowns, but it's also the fortitude to hang on when the stock goes nowhere for a long time. And that can be painful, because it can be just as painful, because there's a number of stocks in the 100 bagger study. Not only are the drawdown severe, but then you could take a point in time and you look 6-7 years where a stock went nowhere. And that is really, really hard, amidst a 100x run.
Right.
So you're sitting there owning this thing, especially, and you're seeing all these other ideas and you're seeing other stocks move, and you're sitting in this thing that hasn't gone anywhere 1, 2 years, 3 years, 4 years. I mean, it takes some patience. So what I do, and what I've learned to do, is not to make that the scorecard, really, to focus on the business. Thomas Phelps in his book has this great table where he looks at Pfizer and he puts the financials for 20 years, and they're just basic snapshot. And he shows you, it's like sales, net income, it's like return on equity, just some basic stuff. And he asks you, looking at this table, is there any reason for you to jump in and out of the stock? Every year it's pounding out 20% something ROE year after year, earnings going up. Every once in a while there's a little pause, but then boom, it keeps going up and up. Of course, looking at that as a business person, you would say, no, this is a asset's performing well. But if you look at the stock price, it was all over the place in that run. I mean, all over the place. So I think the way you build up that kind of exoskeleton is you have to look at a number of case studies, look at past stocks. Like you said, you looked at all those big winners, look at the number of drawdowns they had. So then you learn to expect it. And so that's number one. You got to learn to expect it. And then number two, really just focus on the business as much as possible. And every business has certain key metrics that are really important for that business, and identify what those are and then watch those things like a hawk.
Now, if you only have 10 or 12 stocks, is there like a max position size that you'll let one position grow into before you start trimming?
Well, because I manage other people's money, there's a legal limit. There's a limit I have in the documents that right now sits at 25%.
Okay.
And just internally, I don't push anything past 10, but I would expect over time. I mean, my fund is still young. This is only year 5. So I would expect over time that there would be there's going to be a couple of stocks that kind of, that take over. I hope that happens. That would be a good problem to have. I'm just sitting here riding this thing while it pushes up and takes over the portfolio. That would be okay. And I think that's the key to performance is the willingness to allow your portfolio to get unbalanced and chaotic like that, to really ride a big winner and let it have maximum impact on your portfolio.
What stock have you held the longest in your personal investment portfolio?
This is a good question. Now, remember, I started more as traditional value. So, I started out studying like Ben Graham and Buffett and even people like later, little Marty Whitman was a big influence for a while. And central to that approach is you buy something that's undervalued. And then when it becomes fully valued, you sell it and you go on, you buy something else. So for a long time, that's how I invested. And I didn't have any name that I really held I didn't have anything that I held for like 10 years. I had some stocks that I held for 6 or 7 years. I remember I owned Brookfield Asset Management back when it was Brascan. And I had that for a good long time, 7 years or so. I owned Lowe's Corp, run by the Tisch family for a long time. Leucadia National was run by Cummings and Steinberg. I owned them for a long time. Long time being, again, 6 or 7 years, because that was kind of seemed to be. That's
still a long time for most people. I feel like
it's still a long time for most people. I would say probably a stock so really the clock, so again, fund only started for 5 years, so I can't talk too much about, I haven't had anything very long that way. But personally, I would say, I still have Berkshire Hathaway. I have it in an IRA, and it's been sitting there I think I first bought Berkshire there in 2008. And now the IRA is completely in Berkshire. So that's the longest individual stock that I have held personally.
Were you at the Berkshire shareholder meeting last weekend?
No.
Have you been before?
I've been maybe 7 or 8 times.
Oh, wow. Okay.
And then I haven't been back since COVID, and I just haven't. It's a great experience for, if you've never done it, it's great to go. And not just for the meeting itself, which is a big show, but there's a whole bunch of stuff that goes on around it, because there's so many other investors and things coming in to Omaha. And so I remember when I go there, it's just like meeting after meeting after meeting. You're just seeing people that you would normally see, and then there's other certain events that are held around that. And so it's quite an experience to do.
What do you think of Buffett and Charlie nowadays? I mean, I can't believe they're still running Berkshire. And I mean, I guess no one really knows how much they're running Berkshire versus the other generals, but.
Right. Yeah. I mean, I saw clips of the meeting, and I was going through the transcript before I got on the call here with you. So they seem like their usual selves. They say the same things they usually say, and it's amazing. I mean, it's really remarkable. It's two guys in their 90s, and they're just.
I mean, Charlie's what, 98 or 99?
Yes, and it's really amazing. I don't know. So it makes you wonder, like, what's the investing world going to happen when they're gone? Because they're such like the leaders right now, right?
I was going to ask it, but I almost felt bad asking it.
Yeah. Who's going to be the person who assumes the mantle? I don't know. Who's going to be I don't know.
I mean, like the new iconic figure in the investment.
Yeah. Who's going to be the iconic investor that people think of?
Question. I mean,
but
all the big guys are hedge fund managers, and that's just a different flavor.
Mm-hmm.
There really is no other Buffett coming up the ranks,
not that we know of. And there's obviously two very special people. And you think about there's so much that people have learned from them. I know me over time. I'm sure anybody interested in investing has spent some time reading Buffett's letters and Munger's speeches and things. And it's just a lot of wisdom there.
What else would you like to cover? So we covered the book. What outside of Hunter Baggers, what's your second? Because you've written 5 books altogether. What's your second favorite book? I mean, and Hunter Baggers may not be your favorite.
Right. No, I mean, it's hard to say what's my favorite book because, it's kind of like picking your favorite kids or something like that. They all were written at different times and reflect. I feel
like everyone has a favorite kid. They just don't say it.
They don't want to say it. They don't want to hurt their feelings. I don't want to hurt any of the book's feelings, No, I mean, I like them all. I had a lot of fun writing How Do You Know? Because it just kind of pokes, holes in a lot of ideas people have and labels that people use, value and growth and large cap, mid cap, and what do these things mean? And so that was fun to write. And I hope that it's an entertaining book to read.
So back to trying to find, Hunter Baggers, because I just don't think anyone listening to this podcast is going to find a 100-bagger anytime soon because I know people, they just don't have the patience to hold it. Mm-hmm. Right. I mean, finding a 5-bagger is hard enough, holding it into a 10-bagger, but people take profits. I mean, I might be wrong, but where should they be looking? I mean, like, they
should be looking in like their grandparents' safe deposit box. No, seriously. I mean, it's funny, I'm writing that book. I get anecdotal stories from people. I won't say all the time, but I get probably at least a dozen stories a year from people who will write me and tell me their story of getting a 100-bagger. And I'd say about half of them are usually a family member that's died, and then they discover
inherited.
Wow, grandma's been holding on to XYZ all that time. She was loaded,
Yep.
That a friend of mine just told me last week about his father had a stock, and it was a 530-bagger.
Jesus, I hope it was a big position.
It wasn't a very big position.
10 shares.
Yeah. But still, it was something like, I don't know. I know he had to split it with his brothers, but it was something like, I'm going to mess up the numbers, but I want to say it was something like turning 1,000 into like 60 grand. I don't know. It was something crazy. It was a big, it wasn't a big, well, that's not 500 times, but it was 500 times was the math, and the end result was about 60-some thousand. So
okay.
It was like, man, if you only added a couple of zeros in this additional investment. Yeah. But I've had other times where people own, where some family member that's owned something for a very long time. That's one. It's funny because a lot of these anecdotal stories, they're not investors. They're not, they're not professional investors. They're not even people who are really passionate about investing. They're just people who almost by accident, bought something and just left it alone, held it, and went up 100x, more than 100x.
I got into the business in 2002, and I remember Hanson Natural, which later became Monster. And I mean, I could have bought the stock back then. I traded Hanson Natural back then. I think it was HANS, I think.
Yeah.
I mean, who would have thought that would be a $62 billion company one day? Or
nuts.
Taser, TASR. I was trading that one. I remember seeing the founder on CNBC. And that's become Axon, I think it is, Axon Enterprises. And that stock's up, way up over the last 20 years. So,
yeah, I remember seeing XPEL at a microcap conference. And that wasn't that long ago. And that stock it was this trading for like $1 or $2. It was a little microcap stock, and that thing was up well over 100x.
So my biggest position is Celsius, which is an energy drink company. I've been in the stock for about 3 years. I started buying it at $12 back in April or May of 2020. But 5 or 6 years ago, it was a penny stock, literally trading under 50 cents. So, I mean, that thing's up, 200x basically in the last 5 or 6 years. But I mean, when you see a penny stock, you just assume that it's going to zero. So, why would you buy a lot of it? And,
or hold on to it for a very long time. So, yeah, that's great. So I would say, there's those stories are out there. I always, people want to say that, oh, you can't do it or you're discouraged somehow. I'm like, man, why? I mean, it happens, So that's why we're invested. Big wins.
Where's the best place to find you? Do you spend the most time on Twitter? You said you have a blog too.
Yeah, I write a blog occasionally. Like it's like probably once a month now. When I started it when I started writing the blog. When I started the fund, I would write something every week, and that became every 2 weeks, and that became every 3 weeks. You know how that goes.
Well, like you said, I mean, you can only say the same thing so many
times. That's it.
Before it gets
I've
old.
said that on the blog. I feel like I'm repeating myself. People still seem to like it. So I do that, and then I'm on Twitter. I it's kind of a love-hate with Twitter. I try to put out things I think are interesting or useful or helpful. But I also try to manage my time on the platform. So I'm not, I mean, it's like junk food. You could be on that thing, an hour, and then you run there like, what just happened? Where did my hour just go?
I do the same thing on like Instagram Reels, just a couple funny videos. And next thing you know, you've been watching these videos for 45 minutes. And it's like, what the hell did I waste my time on?
What did just happen? Exactly. But then on the other hand, I've met some interesting people through Twitter. I've found some people. Sometimes people pull out really good research on Twitter. So yeah, it's just a tool that has to be managed, because sometimes, all these things can be distractions. I mean,
where do you get, where have your best ideas come from? Is it from your own research, or is it, like you said, scouring Twitter and picking up ideas?
Yeah, that's another great question. And I wish, I know funds that are much more systematic about it. They're very disciplined. They've got watch lists, and they're, it's all optimized or whatever. But for me, it's very just organic and random almost. I mean, the way I find things. Sometimes, because I've been in the business now almost 30 years hanging around investing. So some of these companies I just know, and they're on my watch list, and I don't even remember when I first found them. But sometimes I do remember. I own Copart, for example, and that's a business that I remember. I have the original report that put it on my radar back in 2012. So, and I didn't buy it then, and it was a shame because it went up more than 10x over the next decade. But so sometimes it's really random. It's just by reading, talking to people. Sometimes you're working on a company, then you find, you're more interested in like a supplier or a competitor or a customer. It just kind of, I wish I could be more, give you a good answer and say, yeah, well, here's what you look, here's where you look, but it doesn't work that way, at least not for me.
Why did Copart go up 10x? Was it revenue growth, earnings growth, combination?
Yeah, it was a combination of revenue growth and then an increasing in profitability that came with scale and their network effects.
Okay.
Taking market share. So those combination things, it's been a very impressive run. The founders has a book he wrote called Junk to Gold by Willis Johnson. I definitely recommend that. If you're interested in Copart, it's a good story. Tells you all about it, the rise, and then you get to see, wow, 100 bagger came about to be.
Are they the market leader in what they do?
Absolutely, yep.
Okay.
And I would say maybe 5 or 6 years ago, they were maybe pretty close with another company called Insurance Auto Auctions, IAA, but they have since beaten that company pretty badly. So I would say now it's probably 60-40 split between the two of them.
Did they ever try to merge?
I think they probably have problems doing that from an antitrust point of view, because in this industry is basically those big two.
Okay.
But IAA was acquired recently by Ritchie Brothers.
I'm not familiar with them. Is that like a private equity group?
It's a Canadian company, Ritchie Brothers Auctioneers. So they do salvage, but it's for yellow iron. So things like tractors and I don't know. I mean, I've did a little digging about that transaction, and it seems like, from what I can tell, the CEO of Ritchie Brothers may be more of I was attracted to the value of it and is incentivized to grow the company. And so they did that transaction, but I don't think it's necessarily one where, they're going to rescue IAA because the problems, I think the competitive disadvantages IAA has against Copart were a result of years and years of underinvestment and will take a lot of money and time to correct.
This is where you talk about, companies reinvesting in the business. That's it, right?
That's a good point. It's a good point because IAA also paid a pretty significant dividend instead to their parent, where Copart paid no dividend and reinvested. And for a while, you wouldn't necessarily, maybe couldn't see it, but certainly over a 5-year time now, it's apparent, and it's very difficult for IAA to fix.
I mean, you're seeing that right now with it. Is it Fox? I'm trying to think of which one of these. The Murdoch family, is it the daughter that has a big stake in a company?
Right.
She don't want them to cut the dividend because she owns so much, so many shares that cutting the dividend is, taking money out of her pocket.
Mm-hmm.
So, I mean, rather than investing in the business and trying to keep up with the other big streaming players. And I think the board finally said they were going to cut the dividend. But, like you said, in some of those big family owned businesses, they don't want to cut the dividend. They want to pay themselves first at the expense of the company's, future prospects. So,
yeah, this kind of falls under the whole capital allocation umbrella, and that's an important part to evaluate with these businesses you're going to own for a long time. It's what they're going to do with their profits.
Do you stay away from the companies that are dependent upon an underlying commodity? Like energy stocks. I know you mentioned mining stocks before. I mean, even the bigger mining stocks, the Freeports, and do those types of companies typically scare you because there's the price of the underlying commodity that can drive the stock price?
Yeah, I mean, I generally prefer businesses that have a product which they have some pricing power. They can defend it, they can raise prices, and this has been a good test of that thesis over the last year or so. We've had higher inflation, so you get to see who's protected their margin and who hasn't.
Right.
So definitely, I prefer the companies that have the ability to raise prices and protect the margins.
Right. It's funny when you see like a Pepsi or a Procter and Gamble report earnings, and revenues are up 4% year over year, but it's all from pricing increases. They're not selling any more products. They're just, selling products at a higher price. But that consumer is, so addicted to that particular brand, they're not willing to trade down yet. So, well, Chris, this was fun, man. I really appreciate your time. Thank you for taking the time this afternoon. I appreciate it. And I will make sure that we post the links to your book. I assume it's on Amazon still.
Sure is. Yep. $9.99. Priced it right.
And Audible, I forget what I paid for Audible, but that's an easy way to listen. Do most of your sales come through Amazon? Is it the only place to buy it online?
Yeah, it's through Amazon. Yeah. And I don't remember the split between the book and the Kindle and the Audible, but yeah, there's all three of those options.
Do you still get like residuals every month? You get a check in the mail?
Mm-hmm. Yeah. It's not, life-changing money, but it's not bad. Not bad.
You think you'll ever write another book?
Probably have another book in me. I don't have an idea, but for anything now, but never know. I think there's another book in me somewhere. Yeah. 100. Well, less, I don't think I would do that. I know a lot of people would love me to do 100 baggers kind of second edition or updated edition. I have a lot of ideas for things I would put in that. They're not in the first one, but
when did the first one get published?
It was published in 2015.
Okay. So, I mean, 7, 8 years ago. I mean,
there's a lot. Yeah, sure.
A few more that have hit that number.
Right. Plus there's things I've just learned that I didn't appreciate then. Like, I've written about and talked about serial acquirers, these businesses that are successful, acquires other businesses. There's, there could be a chapter on them. I mean, there's just a lot of things that have happened, but I think it would be a separate book, different book. And
like Constellation. Is that one of the ones you're thinking?
Constellation? Exactly. Yeah. That's a good example. Perfect example. Yeah.
Is Costco's probably 100 bagger, right?
Oh yeah. Mm-hmm. Okay. There's also, international markets. I don't know that I'm the person to do that, but it's been interesting because I've written that book. Other people have done studies of other markets. So there's lots of other things to look at and study.
Where do you think of, outside of the US, where do you think you'd find the most underbaggers?
Well, I mean, I'd say I remember looking at a study I looked at the last decade, and then a lot of the winners have come from India, China, of course, but also the US. US was up there. Japan. I mean, not to surprise you, the bigger, deeper markets have more underbaggers. So, I don't think there's anything wrong with poking around in Western Europe because, again, it's a pretty big market. And culturally, it's easier, perhaps, for most of us than investing in, say, Japan or China.
And stocks are cheap. I mean, in terms of multiples and valuations, outside of the U.S., companies are typically cheaper, right?
Can be. I don't know about typically, because sometimes, I don't know. I mean, it sort of depends on the specific company and industry, I would say.
Okay. Well, we can leave it there. Chris,
all right.
Thank you so much, man.
Jonah.
Yep. Someday.
All right. Thanks.
Talk to you soon. Bye-bye.
Ciao.